Well, good morning, everyone. Welcome to Stock Investing for Beginners. My name's Scott Thompson, Senior Manager here with Schwab Coaching. Brett Crowther's in the chat. Appreciate him. Welcome to Lawrence and Eva and Asaya and Jay Richardson and Lawrence and everybody else that's here today. Appreciate you taking some time out of your Monday morning to be here with me. We've been getting a lot of questions about when do investors consider taking profit? And so what I wanted to do today is to go over kind of the different plans that we're using, also talk about this important concept of when to take profits or when to at least to consider taking profits in your longer term trades. And then also just review kind of what we're doing. We've waited. This is our 13th week of doing this. So if you're new, welcome. Say hello there if you're new and let us know. But you can go back. I'll show you where the playlist is, and you can go back and watch all of our previous episodes to get more details on the different things. But I do want to cover our trading plans today a little bit, what we're doing, give you a little update on those as briefly as possible. But one of the reasons that I've waited until this time in order to kind of address this question about taking profits is because we needed some data to go back and analyze. And so I want to do that with you today together of things to consider when you're looking at opportunities to take profit in your trades, and kind of talk about some of the investor psychology behind staying in trades and taking profits and some of the things that are challenging that I found when I first started trading. So hopefully that'll be helpful for you today. Before we get into that, let me go ahead and remind everyone our presentation today is for educational purposes. Everything we talk about today is for informational purposes, not considered a recommendation of either the stocks that we look at or the strategies that we talk about. We are using the paperMoney software. So be aware there's some significant difference in the paperMoney versus the real money platform. There's also in our paperMoney today, we are doing some simulated things that you can do on Schwab.com, but you cannot do in the thinkorswim platform. So just be aware of that. I'll point that out when we get there. There's no guarantee of the execution of a stop order at or near the stop price. We will be talking about those a little bit today as well. Remember that all investing involves risk, and including the loss of principal. So let me share first my what we're doing. And again, welcome to those of you that are new to our class. We've gone through 3 different types of plans that we're looking at. The very first plan is we're just doing a very simple process of investing every day. The concept here is invest $5 a day in the S&P 500 or the NASDAQ or something that tracks those indexes. $5 per day actually works out to about $7.24 per trading day. So there's some details here on this slide that we're looking at. And so what I've been doing in the paperMoney is we've been kind of forcing a partial share type of transaction in the thinkorswim. Again, just pointing out that that's not available in the real money. You have to either set that up on Schwab.com where you can do some partial share investing, or you can if you have a different way of investing in those ETFs, you could use that. But the idea is just to do something consistently for someone who's new, maybe coming out of high school or coming out of college, just starting a new job, and they want to start this process. One of the keys to, I think, longer term success and potential wealth is having a plan. I wish somebody pounded this into my head when I first, started, left high school actually, is just start investing and saving your money for later. And so it's a great principle, but this is where we're kind of simulating this. And just as an update, we've been doing this partial share thing in these ETFs that track the S&P 500, the NASDAQ, since the 9th of June. And we have 0.81 shares of the one in the NASDAQ and 0.72 shares, I think, of the one that tracks the S&P 500, just because they're so expensive. $5 a day doesn't buy much of a share. So anyway, that's kind of a fun thing. We give a live update on that about once a month on a segment that we don't record, but I'll give an update on what we've got going on. The next update we'll do is on September 29th. All right, so that's plan number 1, is just something for new investors to do to start a habit. The other plan, which is kind of fun, is using a product or a feature on Schwab.com called Schwab Stock Slices. Just to want to point out, Schwab Stock Slices is not intended to be investment advice or recommendation of any stock. there. But you can do this on the Schwab platform. It has to be schwab.com. Again, not the thinkorswim platform. But we're investing $50 every Monday or the first trading day of the week in the top 10 holdings of the S&P 500, which is very similar to the S&P or the NASDAQ 100. And that's been pretty fun. I will show you just a little quick snapshot today of that plan and what we're doing. I did the $5 simulated investment today on those top 10 holdings, and you'll be able to see the different positions that we have. Okay. The other one, and this is the one that we've been probably focusing more on, is we introduced a plan. You know, if you didn't want to just buy and hold something, if you wanted to be a little more active in your trading, then we created an investing plan, and we call it the 2 green arrows. It's a very simple plan, and you know, this is what's essentially triggered those questions like, well, when do we take profit? When do we take profit on these? The market's been a little bit volatile over the last, a couple months that we've been doing this. And so that question has come up almost every single week that we've been doing this, is when do I take profits? Okay. So let me review these rules really quick, and then we'll go back and talk about this concept of when do investors consider taking profits. All right. So the objective here with this 2 green arrow plan, and remember, different plans have different objectives. Let me throw out the very first critical concept that you want to get today, okay? That from an investor psychology standpoint, one of the most difficult things to do is to hold on to a winning trade. We are kind of programmed incorrectly to be great investors. We have a tendency to want to take profits quickly, and we tend to want to hold on to losers indefinitely until they come back, which they may never do, right? So one of the very first things to remember is when you're creating your own investing plans is to try to identify what that objective is. Our objective in this plan is to buy and hold uptrending stocks in the S&P 100 until when? Until the trend changes. Automatically, okay, write this in your notes somewhere, automatically, if you're going to wait until the trend changes, you will be giving back potential gains. Just that took me so long to understand that concept, because you're nice and profitable. The market drops a few days, and it drops a few more days, and it goes below your moving average, which is our trigger for the stop adjustment. But all of a sudden you're back and you're asking yourself, well, dang it, I could have taken some profit on that. Why didn't I do that? Well, that wasn't the plan. That's the point. It wasn't the plan to take the profit at a particular target. We're going to talk about that today, but the objective of this plan is to hold till the trend changes, and you can't do that without allowing some of the profit that you have to be given back before that's evident. Okay, so put that in your notes somewhere. Mull that over in your head and learn to either accept that, or now here's the other point I want to make, is this is not a short-term trading plan. Okay, most technical traders, most short-term traders must have a target. Okay, that's how you take profit in a trade, is you get in at $50 and you say, well, I'm going to sell it at a certain percentage or a certain dollar amount. And so short-term traders, in the opinion of most short-term traders, should have and would have a target to get out when the trade's profitable, and they would have an exit for when it's not profitable or if it goes against them. This particular plan, again, is more of a buy and hold intermediate to longer term plan that doesn't have those components. But now that we've got some data, I just want to review the process now. Again, our point today, our main takeaway is, when should investors consider taking profits? So I want to discuss that with you today, but I've got to go through kind of what we're doing first. All right. Now, what to buy? We're just trading very simple. We're going to talk more about other ways to determine what to buy, but we're just using the public watch list of the S&P 100. We've kind of limited between $20 and $220 just because we're trading a smaller $10,000 mock portfolio for our sample investing plan. All right, when to buy. Now, we've gone through this before. I'm going to go through this very quickly. You can go back and watch episode 3 and see the details in our description right now in the webcast. There's a link for this type of chart. If you want that chart set up, there's a little script for that. You can pull that up. No, not guaranteed for time or accuracy, but we're just using a simple chart. Okay, 3 to 6 month daily chart. We're having a 50 period simple moving average on there. And we have an 817.9 MACD histogram with breakout signals. And what the breakout signals are the little green arrows or red arrows. And you can activate that on your chart by, show breakout signals is when you're editing that study, do show breakout signals, change it from no to yes, and then you'll have the arrows like everybody else. All right. So the buy signal. Now, this is, again, we're just covering this just mainly for the new people that are attending today. But the buy signal is really simple. If there's 2 green arrows, that's the name of the plan. If there's 2 green arrows when the moving average is rising, we're going to consider that a buy signal, and we're going to buy the shares. Now, how much to buy? Well, because we have a mock $10,000 portfolio, we decided we're going to invest no more than 5% of the portfolio in any single position, and we're going to not risk any more than like $50 per trade. Now, let me show you how that works. Is if you take the risk per the trade is $50 and you have a risk per share of some amount, then that will tell you how many shares you can buy. So in this quick example, if you were going to buy a stock, we're willing to risk $50. The difference between our entry price and our stop price is, say, $12. Then we could buy 4 shares. 50 divided by 12 is 4, more or less. And, let's say the stock costs $125 per share. Then we'd want to do a check and say, well, I don't want to invest more than 500 or 0.5% of my portfolio in any one position. So I could say, well, that'll allow me to buy up to $500 worth of that particular stock. And so in this case, we'd buy about 4 shares, and we'd be within the parameters of these 2 risk components. Now, again, if you want to go more details on this, go back to episode 3 and you can watch, and we did some calculation and some examples. All right. Now, this is the deal. Today, the question is as well, when do we take profits? When do investors consider taking profits? Well, in this particular plan, we have some set rules already. Okay, the initial stop, we set 1% below the 50 period moving average, and then we adjust the stop. And you don't have to do this. This is just when some consider doing this, is because people have this kind of thing in their head. It's like, well, I gotta move my stop up. And one of the mistakes that I made when I first started investing is I had a tendency to move my stop up too quickly, and I got stopped out of trades. And I made another mistake because I didn't look for a new entry opportunity. But how many of you, I'm just curious, go ahead and chat this in. I know there's some questions in there. Brett will take care of most of those. I'll go back and take a look myself as well. But, how many of you have been stopped out because your stop was too tight, and then the stock kind of ran away, and you look back on it a week later, a month later, 2 months later, and you think, oh, wow, look at that. I could have had this big gain, right? So these were challenges that I ran into. And so, one of the reasons that I think investors and traders need to have a rule set that they follow is to help minimize some of the emotions that's attached to money, losses and gains, right? So we have a very simple rule as we move the stop up. If we got a new 2 green arrow buy signal, that's a signal that we could move the stop up. We also look for 2 red arrows. If the stock closes below the moving average and then closes the MACD and the moving average now have 2 red arrows, then we could move our stop up, and we're trying to give the stock a chance to stay in the trend, right? That's our objective, to buy and hold stocks in the S&P 100 while the trend is up, and hold it as long as the trend is up. But if it starts making lower lows and lower highs and it goes down and hits our stop, then at least temporarily that trend had changed, and that's why we got out of the trade. Okay, so that's the plan. Okay, now the other thing here that we don't have, and this is what we're considering today in our plan, is when could or when might investors consider taking profit. Okay, so now what I want to do is I want to show you the trading journal that we've been using. Okay, there's a link to this journal in the description right now, so you can go there. This will, that link takes you to the Schwab coaching page, and then you'll have to find this Stock Investing for Beginner webcast, and then just scroll down, and there's a link that says Trading Journal, and you can download this trading journal there. And then there's a couple videos that you can watch as well. But I want to show you what's happened in our portfolio since June 9th. We've stopped out of 8 different stocks. We had Intel, we did a little bit of an adjustment there. We tried to give a little big wiggle room, and we had a stop below a one level, and it actually hit both of our stops. And so there's two Intel stops. We sold half at the first stop and then the second half at the next stop. Okay, but I wanted to show you this first to kind of lay the foundation here as we study together, and I'm going to kind of quiz you along the way, is when do investors consider taking profits? Okay, so you can see here we've had some small. Okay, very first thing I want to point out is we were willing to lose how much? Okay, those of you that were paying attention about 5 seconds ago, how much were we willing to lose on any single individual trade? Not how much we were investing, that was 500, but how much were we willing to lose? Okay, in our sample plan. Your rules or your loss acceptance might be different, but chat that in. Okay, how much were we willing to lose? Well, we calculated, right? We calculated that we could lose up to $50 per trade. And we position size based on some of those rules. Now, the first thing to consider, everyone, is when you have a loss. Now, put this in your notes somewhere as well. You are going to have some stocks that don't work out. You're going to have some purchases that go against you. You're going to have some things that just don't work out. And that was another hard concept for me. As crazy as it sounds, I thought every valid buy signal would be a profitable trade. Okay, that is not the case, everyone. I've seen what I would consider a perfect buy signal end up into a losing trade, and I've seen what I would consider a horrible buy signal completely against whatever rule that you had or plan turn into a winning trade. So the point is we're going to have some losses, and you better get comfortable with a loss. And how you do that is really not too challenging, is you just ask yourself, what am I really, truly willing to lose on this trade? Not one in the future, because the one we're taking now, obviously that one can't be a losing trade. I wouldn't take a losing trade. If it was going to be a losing trade, I wouldn't buy it. Well, you don't know that when you buy it. So the point is when you take a loss, or when you're going to have a loss, how much are you really, truly willing to lose on that position, and pick a number. Now, after you get that number, what you should do is ask yourself, hey, if I had this loss happen to me 2 or 3 or 4 times in a row, would I still be okay with that original number? And most people find that they aren't okay with it. So you'll need to go back and adjust that first answer. How much are you willing to lose on the trade? We said $50. Now, here's the fun thing, at least in my opinion. I don't like losing. I hate getting stopped out of stuff. But the first question I ask, are these acceptable losses? Okay, based on the rules that we're trading, $21, $26, $6, $29. Are those acceptable losses based on our rules? The answer is yes. These are all below the $50 threshold that we were willing to lose on the trade. Okay. Now, what I want to do here is I want to give you some numbers, because again, we're considering this question. Okay. When might investors, okay, this is different than traders, consider taking profit? Okay, this is the this is what I want to talk about today and spend our time today on, is this. And we needed some data in order to do this together. And so, when do or should investors consider taking profits? All right, did I spell consider wrong? Conditioner. Little dyslexia coming in there. Consider taking profit. All right, now let me give you some data based on the Trading Journal. Now, so of the positions that we have, okay, we got stopped out of 8. Okay, and I apologize here. We've been stopped out of 8 positions, not 5. I don't have 8 fingers, but okay, 8 total positions that we've been stopped out of. Okay, 2 of those 8 never really went above the purchase price. Has that ever happened to you guys? You buy something and you happen to buy right at the top. It's like, it just didn't keep going. You have your valid entry signal, but that was like the top of the market, and then it just fell down and stopped out. I think we've all experienced that. If you've been in the market for any length of time, you're going to experience it if you haven't already. So again, that's not something that's horribly uncommon. All right. Now, here's another thing that's interesting. Okay, 6 of the 8. Okay, now this is again to our question here: when might investors consider taking a profit? Let me highlight that. 6 of the 8 that we got stopped out of, meaning the trend changed at least temporarily. 6 of those 8 would have had a potential max gain of 3.5% to 8.3%. Okay, and I don't have time to go through all the data here. You can see the stocks that we stopped out of from the journal. I also included the entry date. If you want to go back, you can go kind of figure out these numbers together there. Now, here is something that's so frustrating, okay? One of the most common things is that we hear as coaches, and that, probably talking amongst yourself, is, when you're trading, people hate stop losses. Now, why do they hate stop losses? Well, we have some evidence today, okay? 7 of the 8 positions that we got stopped out of are above the stop out price. How does that make you feel? Huh? How does it make you feel? 7 of the 8 that we got stopped out of are above the stop out price. Now, that doesn't mean they're all profitable. I'll give that data in a second. But 7 of the 8 that we got stopped out of are actually now trading above the stop out price. Now, I talked about this a few weeks ago and I have considered this. I think 2 or 3 of the stocks we got stopped out of actually gave a new buy signal. I just didn't have either enough money to rebuy those stocks, or there were other stocks that had buy signals that I thought had stronger trends, and so we paper traded those instead of the ones that we got stopped out of. Okay, but this is something that is also not too uncommon. One of the reasons people dislike using stop orders sometimes is because a lot of times those get stopped out, and then a week later, a month later, whatever, they're trading above the stop price. My suggestion was a few weeks ago is if that stock still meets your criteria, it's okay to go in there and rebuy it. And you'll probably have to buy it above the stop out price and maybe even above your original purchase price. Okay. But I wanted to share that data with you because I think it makes an impact when we consider this question: when might investors consider taking profit? Okay. So let me give some other just data points here. 5 of the 8 are still below the initial purchase price. All right. 3 of the 8 would have been profitable, or are currently profitable had we stayed in. Okay. So this is the data that we have, and let me show you again the little trading journal here. We've been stopped out of these 8 positions. There's actually 9 lines, but that's because Intel was kind of hit twice here. Some of these are above their purchase price. Some of them are still above the stop out price, but they're still below the initial purchase price. And so now we're considering this idea, many times in the last few weeks here, people have been asking me, when might investors consider taking profits? Okay, now I'm going to throw this out to you guys here, and I want you to chat in now based on this information. Okay, based on this information above, okay, is there a time that it would have made sense to take profit? Okay, important question. Okay, especially now that we've had some trades. We've been maintaining a little mock portfolio in our paperMoney of 20 open positions. Like this morning on the open, 6 of them were, in a loss position, and the other 14 were profitable to some extent. Okay, but let me see what you guys are chatting in here. What and when, does it make sense in this scenario? Okay, we had 6 of the 8, went up to as high as 8%, which is a pretty healthy gain on a stock investment, right? When would you have considered maybe taking some profit on those? Any ideas? And chat in something just to make sure I can hear that you hear me. I'm looking at the chat here, but when does it make sense? When does it make sense in this scenario, or does it? All right, we'll mull that around a little bit. And so let me just throw out an idea here, okay? Let me throw out an idea. Okay, and we'll talk about this, and this will probably become our sample rule here. What if we scale out at a certain percentage? Okay, something to consider here. BJ says if we have a target. Okay, this plan doesn't have a target. That's kind of the point here, is like, when do we take profits? Well, short-term traders take profit when the stock hits the target. And they're willing to give up that additional gain they had because they're going to be looking for another short-term trade right away. Longer-term investors really have a little bit different mindset when it comes to taking profit. Now, since you guys are thinking about this, when might investors consider taking profit? We actually do have a rule that helps us take some profit in this plan. Okay, we just haven't hit it yet. But, as the stock continues to trend and the stock, makes higher highs and higher lows, and we adjust our stop up below the 50-period moving average at a point, and we have this point with a few of our stocks that we currently have on in our paper money, is the stop is now above that original purchase price. That is essentially the profit-taking mechanism in this intermediate to longer-term plan. Is as the trend continues, we start moving our stop up, and eventually, usually it's about 6, 8, 10 weeks later, the stop that we have based on the rules is now above the original purchase price. And of course, there's no guarantee we're going to get stopped out there. Could be filled much lower than that. But that's a scenario where we could take some profits. We just haven't had one of those yet. We had one loss that was only $6.10, if you remember that one from the Trading Journal. But that was probably as close as we've had to taking profit. Okay. But now I see some of you have chatted in here. You're talking about technical signal. I'm a long-term investor. So it's challenging. People have been asking me, when do investors consider taking profit? Well, in order to answer that question, I think you need to have some practice data. Go paper trade 20, 30, 40, 50 stocks with a rule set, and then you can go back and do what we're doing, okay? And so this right here is a mechanism that people talk about. Now, before we move on, okay, and Pa says, is it not better to use a trailing stop? Well, a trailing stop has the same challenges. You could trail your stop by a certain percentage, but what percentage is that? Is it 3%? Is it 2%? Is it 5%? There are some challenges with the trailing stop because some stocks tend to be quite volatile, and that stop will raise as the price of the stock goes up and then knock you out of the trade again. Before what? Before the trend is over. And this, please take this away out of this webcast. This plan is an intermediate to longer term plan meant to stay in a trade as long as the trend continues. Any adjustment to your profit-taking mechanism other than what we have with adjusting the stop above or on a new buy signal or that 3 red or 2 red arrow signal that we get, kind of defeats the purpose of holding a stock in an uptrend, okay? So one of the answers, and I'll throw this out there right now, when might investors consider taking profit? Well, in an intermediate to longer term plan like we're trading, we've got that. We adjust the stop up, and hopefully that trend lasts long enough that our stops get above our original purchase price. And so if we do get stopped out in the future, we can have a small profit on that. But remember what I said, a trend plan where you don't know if the trend changes until it makes that lower low, you're going to be giving back some of the profit. I wish somebody told me that in the beginning because it's so important to understand that particular concept. Okay, now, before we answer the question here, before we answer the question about when might investors consider taking profit, please consider this, okay? Whatever we do here, based on kind of what we thought would happen with our stocks that got stopped out, we absolutely have to know how it would impact the stocks that we currently have. So let me give you some data on this one, okay? Very important that you consider this, because you can't answer the question of when investors might consider taking profit unless we know how it will affect our other positions. So let me give you some other data here. And, then we'll see what you guys think, okay, of our current positions. Okay, and we have 20. And this is as of the close on 9/5, as of Friday's close. Okay, 6 of the positions are at a loss right now. Okay, that means 14 are at a gain. Okay, that's how it was on the close on Friday. 6 of the positions that we bought hadn't hit our stop loss, but they're not making any money. They're showing a loss. 14 of them are at a gain. Okay, now of the ones that are at a loss, okay, the max gain on those is between 2 and 5.58%. Okay, so of our open positions, let me just show you these real quick. Okay, so here's our open positions, and right this second, 1, 2, 3, 4, 5. So the market's been moving around. We've had as many as 7 be losing money here on the P&L open, and as many as 6 or as few as 5 that are losing money. But these are our open positions, and like I said, they're 6 of these, on Friday's close were losing money. The P&L open was showing a loss, and 14 of them were showing gains. Okay, now as we consider these concepts of like when might we scale out or when might we take profit, okay, let me give you some data here on what's going on. Of the ones that were losing, their maximum gain was only 2 to 5.5%. They just didn't make very much money. Of the gain, those that are showing the gain, max gain on those is between 6.93% and 20.75%. Now, here's another really important key point to get out of this as you consider, okay, when investors might consider taking profit. Please understand that whatever you do to maybe maximize the profit on something that lost money, okay, something that had a 5 or 6 or 8% gain, how would that affect your other positions? We have a couple of these gainers in our paperMoney account here that are making 20.75%. Another one's up 16.78%. One of them's up 19.94% at their highs. So if we had taken profit at 4%, on some of these, then we're missing out, right, on the ones that actually do trend. And so, these are some things to consider as you look at and consider, when do I take profits on my trend trades? Well, again, with this data, and let me repost this question here, okay, down here at the bottom, and let's throw an answer out, and then we'll do some paper trading around that. Okay, when might investors consider taking profit? Is it a certain percentage? Do we want to scale out of something? Do we want to sell parts? Scale out means like if we had 10 shares, we'd sell 5 or sell 3. You scale out. You take some profit on some of it and not the rest. Okay, but here's kind of an idea, and I want to just be transparent and upfront with you. The plan that we have that does have a profit-taking component, it's just not what everybody thinks. It's that stop adjustment there. But if you wanted to do something else, and so what we'll do is we'll incorporate this concept into our future purchases, okay, is because when you're in a trade that actually trends, there's potential to make 6, 7, 10, 20% or more. What about Apple or Google or some of these other ones that have had, tremendous growth over the years? The objective of this plan is to try to stay with a trade. And so, rather than having a set like technical target on our longer term and intermediate term investing plan, we're going to incorporate a little bit of a scaling out plan. Okay. And again, this is just for example purposes. There's nothing inherently special about this. It's just based on the data that I see here and based on kind of where some of the closing numbers were, our percent gains is, let's do this. We're adding a scale out rule to our longer term plan. And this is again, just for example purposes, but we're going to sell half of the position at a 5% gain. Okay. And what does that mean? Well, if the stock is up 5%, then we'll take some profit off the table. We'll continue to follow the other stop adjustment rules, and we'll just look at that. Okay. And then, so what I'll do on our current open positions, this is kind of now we're adding this rule, sell half the position at 5% gain, follow other rules. And so let's do this. I'm going to just copy this into our data as we kind of wrap up today. I'm going to add this to our plan, and then we'll do a quick summary of everything. Okay. So we're going to add this little rule. Okay. Scaling out, sell half the position at 5% gain. Now, again, you guys don't have to do that. This is many of you I've seen chat in here. I really like the 2 green arrow plan as it is. Perfect. Just keep practicing that in your paper money. If though you feel more comfortable with having a rule set that allows you to take some profit, here and there, if you want to scale out, if you want to remove some of that risk maybe from the current open position, then you could do that. And so maybe what I'll do here on C, since we have a nice little profit on C, let's first calculate where that profit would be. Okay. So we bought the stock for $81.38. What's 5% of that? You guys, can you help me out here with the math? Let me pull up a calculator here real quick. So 81.38 times 0.05. Is that right? 5%. Should be about $4. So if we could take a profit of about $4.06 per share, then that would meet our rule, right? So let's see where that is. Now, currently that's trading at $95. Now, again, this should be evident right here of why we may not want to do this, right? Is we have a nice profit. What do we got? We got $14. What's $14? I'm going to write down that 406 number just so I remember it. Is, what's $95? How much profit do we have in our paper trade here, our example trade? Well, let's take 95.27 minus our purchase price, 81.38, and that's up $13.89. If we divide that by our purchase price, 81.38, that's a 17% gain that we're sitting on right this second on C. So, the question then is, do we want to scale out? And so it's something that you need to consider. And I'm not telling you to do one of these things one way or the other, but the point is, if you have a rule like we do, just to move your stop up as the trend continues, nothing wrong with that. All right. If you want to have a scale out rule, nothing wrong with that either, but just know how it impacts your trades. We wouldn't have had a 15% gain or 17% gain on C had we had the scale out rule. We'd have maybe on 2 shares, right? That we could do that. But like I said there at the beginning, I wanted to do this on future purchases. So, when we take a new trade, and I've got 20 open positions already, so we're kind of fully allocated over here today. So as we do some new positions, and probably next week when we do some new trades, I'll go ahead and add, and I'll show you how to do an exit plan or an exit rule with this one. In fact, I can show you that now as we kind of wrap up today. Let's say that we're going to buy, Walmart here technically has 2 green arrows on it. It's kind of trading back above this resistance level. Let's say we were going to do this on Walmart today, and we were going to buy like 4 shares or 5 shares because it's $100. But this would be kind of how that works. And I'm not going to place this trade partly because we already own Walmart. But what I want to do is show you how to do it. Okay, right click, buy custom. And because we're going to sell part of it, we'd have OCO bracket. That's the order type. And you can go back and watch the recording because I'm going to go through this pretty quickly. OCO bracket. Now, let's say we're going to buy, let's do simple math. Let me shrink this down. Let's say we're going to buy 6, or we said 4 shares, right, to stay within our $500 max. And we're going to sell 2 where? And we're going to sell 4 where? Well, and I didn't run the numbers here, but let's just say for fun that, 3% below support or the moving average, let's just say that's at $95 for our stop loss. And that would be a stop order on all 4 shares, good till canceled. Okay. And let's say we wanted to have a profit target of 5%. Now we can do this a couple ways. I'll show you the math part. Let's just use the calculator because I like using the hard numbers rather than like there's a mechanism in here that you can say when it's up 5%, just sell it. But let's calculate it. Okay, so if we buy something for 101.28 times 1.05, that will be our target on half. So 106.34. So we're going to put 106.34 here. And oops. 106.34, make that good till canceled. And the way this works then is we're going to buy 4 shares at whatever the current price is based on the entry rule. Then we're going to sell half. We're going to scale out based again on, when should or when could or when might investors consider taking profit. And we're just saying, well, based on the data, I can see that maybe we sell, at 5% or more. Okay. And again, this is just sample example. All right. Then we're going to have a stop on all 4 positions. Now, I see a comment in there, sell 2 limit, sell 2 at the stop, not 2 and 4. Actually, Ted, it is 2 and 4. Let me show you why. Okay, so what's going to happen here, this is an OCO order. And Ted's awesome to keep me in line here. He's had some great comments along our class. But this is why this is how I would do this order, Ted. Is we're going to buy 4. If it goes against us right away and stops out, we'd want to get out of all 4 of them, right? So like if we bought it and it just kept dropping, stops us out, we get stopped out of all 4. Now, what would happen if and when this order triggers? Well, because it's a first triggers OCO, that means one cancels other. So if the 4 gets stopped out, then it would cancel the 2 order, right? It would cancel this 2 order. Now, Ted is making a good point, though, is if it goes up and hits our target and it sells 2, what's going to happen to our existing stop order? Well, it'll cancel this existing stop order because we wouldn't want to sell 4 at that point, right? We'd only want to sell 2. So what we'd have to do here, and this is maybe the point that Ted is making, is that if and when we hit scale out, then what we could do is, adjust or put a new stop on the remaining 2 shares. Now, there is another way, and I'm sure Ted knows how to do this, is there's a feature called first triggers to OCO. And you could set it up that way, Ted, as well, where you put sell 2, and then you have the other, sell 1, really. It's not another bracket order, it's just another stop order. Okay, but this one seems the most intuitive to me. This is how I learned it when I started. Stop out of everything that goes against you, get out of half at your target, and then you'd have to reset the stop on the remaining 2 shares, which would probably be above the 95 at that point anyway, right? There might be a new buy signal in there. There might be, a higher level of support that you could use. Okay, but I did want to show you kind of how to do that. Again, I wanted to just in summary show you this. We've been buying the top 10 holdings. If I click here, you can see that we made a purchase every single week of $5 per share on these. And then we'll go through all of the 29th of September. We'll do an update on our ETF one that we don't record. All right. And last thing I want to do is just show you the resources. I've already mentioned down in the journal there, or not journal, but the description of the webcast will have a link to the trading journal, There's a link to the chart that we're using. There's some links to some webcasts that'll be helpful for you. But here, if you just, and I'd appreciate it if you subscribe to our channel, Trader Talks. On the home page, if you come over here, click on playlist, then you can see our stock investing for beginners playlist is right here. Do a full playlist, and then you can see all of the episodes we started back in June. So episode 1 was there in June, and tried to build the case for why you might be an investor. All right. Now, the last thing I want to show you too, and this is something that I've enjoyed doing. Sometimes Brett and I can't get to all the questions that are in the chat. Brett's doing a great job of answering your questions there. But if there are some that are left over, then what I like to do is in each session, I'll come in and put, a question from the survey or a question from the live, question from the live session, something like this, and I'll post those questions in the comment area of that particular webcast, and then you can go back and review those. You can also put your own comments in there, and that works out great for us because I'd love to have you, throw a comment out. If you have a question there, go ahead and chat that in. All right. Now, again, as we wrap up, just a quick summary. I wanted to, we reviewed our open positions there just briefly. We reviewed some of the things that were stopped out. We discussed, when might investors consider taking some profit. We landed on a sample rule of maybe scaling out of half the position when we have a 5% gain. Follow the other rules that are intact at the same time. And then we also just kind of reviewed the 3 plans that we're doing. So hopefully this was helpful for you. Go back and review any part that you need to get that answer. Subscribe to our channel. Reach out to others and share this information with them. We appreciate that. Have a great day, everybody. And good trading. See ya.